U.S. Market Analysis for Tuesday, March 10th, 2026. This video presents a direct, informational narration of the source document, no interpretation. And before we get started, the initial risk disclosure and important notice. This presentation is for informational purposes only and does not constitute investment advice. There is a significant risk of principal loss in all investing, and past performance is not indicative of future results. All right, here's our agenda. First, we'll cover the market overview, which felt like a real tug-of-war today. Then we'll dive into the Strait of Hormuz crisis. After that, we've got an analysis of Oracle's latest earnings. Then we'll look at institutional positioning and flows, check in on key macro risk indicators, and finally, wrap it all up with a conclusion on strategic patience. So let's kick things off with the market overview. The day was marked by this back-and-forth action that ended in a pretty significant afternoon sell-off. And what was driving this was a conflict between, the diplomatic talk we were hearing versus the actual reality unfolding in the Middle East. It just goes to show you how fragile the market's footing really is. Well, the market initially found some support on remarks that the war might be ending soon, but that turned out to be more of an expectation management tactic. What really happened was U.S. War Secretary Hegseth announced that the United States was about to launch the fiercest strike to date against Iran. And then, adding to the confusion, Energy Secretary Wright posted on social media that U.S. tankers were already being escorted through the strait. That sent oil prices plummeting, but the post was deleted just minutes later. This whole mess created what can only be described as a roller coaster for oil prices and set up some pretty nasty volatility traps. All this political rhetoric is really just the surface layer. The real substantive threat, that lies in the escalation of geopolitical tactics right there in the Strait of Hormuz. Okay, Section 2, the Strait of Hormuz crisis. We're now in what you could call an asymmetric warfare stage. This means Iran is using these mind-based tactics, which have a huge psychological impact. It's creating this widespread fear about a major energy supply shock. Tactical intelligence indicates that Iran is using small, hard-to-detect vessels to deploy these mines covertly. And here's the kicker. Their inventory is estimated to be somewhere between 2,000 and 6,000 mines. That's a massive number. Naturally, this has triggered a pretty stark warning from the U.S. president. The U.S. president demands Iran immediately clear the mines or face unprecedented military consequences. So how is this impacting the industry? Well, first, there's an insurance underwriting vacuum. Insurers are just not willing to provide coverage for any mine-related risks. Second, the oil and LNG tankers themselves are incredibly vulnerable. They're basically explosive targets. This is deterring any passage, even with military escorts. This whole situation creates an unavoidable upward price shock risk for energy. All right, let's switch gears to Oracle. They have this unshakable position in AI infrastructure, and they just posted strong earnings. The stock popped about 8% in after-hours trading, but there's still a lot of market disagreement here, and it's a classic story of high growth versus a debt-laden balance sheet. Let's look at the core operating metrics. Adjusted EPS came in at $1.92, beating the market expectation of $1.85. Revenue was $65.3 billion, again, beating the $64.7 billion expected. But the big number is the RPO, or remaining performance obligations. The actual result was $553 billion, absolutely crushing the prior value of $341 billion. The company also raised its forward guidance. The FY 2027 revenue target is now $90 billion, up from the previous $86.7 billion. It's a clear signal of confidence from management. So with all that good news, why the valuation discount? Let's get into the core risk analysis. The first risk is a potential CapEx exhaustion warning. Capital expenditures as of the third quarter hit $48 billion. That's nearing their full-year target of $50 billion. This accelerated spending rate could signal a future financing gap. And the second risk, the market is deeply concerned about Oracle's dependence on receiving payments from OpenAI. This raises serious business sustainability questions. If anything happens to OpenAI, a huge part of Oracle's RPO could be at risk. Now for some technical levels for reference. On the upside, resistance is at 164, 176, and 185. On the downside, support levels are between 137 and 143, and then down at 120 to 127. It's also worth noting that the recent rally seems to be more about short covering than new buying pressure. Okay, Section 4. Let's talk about institutional positioning. Right now, market control really remains with institutional algorithms and CTA strategies. CTAs, or commodity trading advisors, are trend-following funds, and their automated moves can really amplify market swings. Here's an urgent update on those CTA levels. The upside sell pressure trigger is at 68.94. If we hit that, expect their algorithms to start taking profits. The downside liquidation threshold is 67.63. Now, the day's close was at 67.81, so we are dangerously close to this level. Breaching it would trigger a new wave of forced selling. And then there's the liquidation-style dump level at 63.64. A break below that would force CTAs to cut their equity exposure by more than 55%, pushing the market into deep oversold territory. As for fund flows, JP Morgan data shows hedge funds have been net sellers for 5 consecutive days. ETF inflows are at a 2-year low, which is a big defensive signal. And looking at regional CTA liquidation risk, Korea is at the 90th percentile, Japan at the 77th, and the US is right there at the 60th percentile. So the risk is elevated across the board. Moving on to our 5th section, key macro risk indicators. The 10-year Treasury yield is, without a doubt, threatening the valuation foundation of growth equities right now. We're seeing a pattern of rising bottoms in the yield. A breakout here could lead to what the report calls a potential fracture-style downward repricing for unprofitable growth stocks. This is exactly the dynamic we saw in 2022, which was just devastating for the tech sector. The key range to watch is between 4.2 and 4.25%. A break above this narrow band is the critical trigger. And now for a volatility assessment. The VIX index is sitting at 24.93. That is firmly in the high-risk regime, which starts at anything above 22. A real safety signal would be seeing the VIX fall back into that 17 to 18 range. At the same time, the MOVE index shows that bond market volatility remains highly active as well. So let's bring it all together in our conclusion. The market is basically in a parallel space, where the optimistic official narrative is completely disconnected from institutional money flows and on-the-ground reality. This calls for strategic patience and, frankly, risk avoidance in a clearly misaligned market. The core investment strategy recommendations are as follows. Number 1, tight position control. The market is extremely choppy and prone to sharp reversals. Number 2, avoid valuation traps. Unprofitable growth stocks face significant headwinds from rising Treasury yields. And number 3, patience above all. In this environment, capital preservation is the primary objective. Professional risk disclosure and important notice. The information and data presented in this material are for informational purposes only. It is not intended as a recommendation or solicitation to buy or sell any security or financial instrument. All investments involve risk, including the possible loss of principal. The content is based on information from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is not indicative of future results. The views expressed are subject to change without notice.